Good morning, and welcome to Coin Expo Santa Clara. I'm Scott Griffin, your host, and Coin Expo Santa Clara is a rare coin and precious metals exposition. Today, joining me is Mr. Brent Johnson of Santiago Capital. Welcome, Brent.
Thanks, Scott. Thanks for having me.
And Santiago Capital is a gold-focused wealth management firm. Tell us a little bit about your history with Santiago Capital, Brent.
So thanks for having me here. It's nice to come down and talk to you. So I have been in the wealth management business for about 20 years, and it was probably in the mid-2000s when I started looking closer at gold. I had kind of known about precious metals from when I was a kid. My dad found a rare coin that was worth a lot of money, so that kind of piqued my interest in it. And then in the mid-2000s, kind of prior to the crisis, we started allocating more to gold. But I still really didn't know what I was talking about, to be honest. I just kind of felt it was important to have. But once we got into the crisis, and I saw what was going on with the monetary system itself, and really dug into the inner workings of it, I just felt that gold was an extremely important part of everybody's portfolio. Now, everybody may have a different amount that they should own, but I think everybody should own it. And so it's at that time where I started, advocating for it more.
Okay. And we all have our own projections on where gold is going. You mentioned earlier in our conversation that you think gold is going to go down before it goes up. Tell us why you think gold is going to go down before it skyrockets.
Yeah, so I don't know that it is. So it's not necessarily a full-on prediction, but that's my sense. And my sense is that the reason that it's going to go down is I think the dollar is going to get a lot stronger in the short term. And I can kind of go through why that is. And typically, gold and the dollar are somewhat competitors. A lot of people feel like when the dollar gets inflated away or when the dollar loses value, gold will go up. So if you have the opposite of that and you have dollar getting stronger, it won't necessarily push gold down, but it's certainly a headwind.
And so one of the things I've heard on some of your other comments, Brent, is this dollar milkshake theory. Tell us a little bit about the dollar milkshake.
Sure. So the dollar milkshake theory comes out of, it's really a result of the central bank monetary policies of the last 10 years. If you go back 10 years ago, coming out of the financial crisis, the central banks of the world tried a magic trick, and their magic trick was we're going to take all the bad loans and we're going to make them disappear, right? And they hid them on the central bank balance sheets. And when they took those bad loans out of the system, or the bonds out of the system, they put cash into the system. But it wasn't just the United States. It was the United States, it was Britain, it was the European Central Bank, it was the Japanese Central Bank, it was the Bank of China. Everywhere did it. So they flooded the market with liquidity. And I called it this liquidity milkshake, this currency milkshake. And for years, this went on. And all the central banks were working kind of in conjunction. They kind of had a unified strategy. But about 3 years ago, the U.S. diverged from the rest of the world, and we actually started raising interest rates. We stopped doing monetary injections. We stopped doing the quantitative easing. And when we started raising interest rates, that made our currency look better on a relative basis to the rest of the world. And the dollar milkshake theory kind of came out of the fact that I said there's this monetary milkshake, and now everybody else is injecting the stimulus with their monetary syringes, but we stuck a straw down in there. Now we're sucking out the liquidity with our higher interest rates. There was a movie a number of years ago called There Will Be Blood about this oil baron, and he talked about how he could stick a straw down into his ground and he could suck out all the oil on the other guy's side, the other guy's oil on the other side of his fence. And it's kind of the same thing. In today's markets, they're not just domestic markets. Global capital kind of flows all over the world. So if China or Japan or Frankfurt is injecting capital into their markets, that capital could then flow to the United States. And there's no guarantee that it stays in Europe. There's no guarantee that it stays in Japan. And I think that's largely what's happening. I think that's why our markets have held up better than the rest of the world, is that we're getting that global flow of capital. So we're sucking up that currency into our markets.
Sure. When you talk with your clients about alternative investments like gold, and of course you talk a lot about gold, but where do other alternative investments like, let's say, Bitcoin or tech stocks or maybe small cap stocks, where do those fall in the spectrum for you?
So I think it depends a little bit on the reason you're buying it. So there's some people who buy gold to make a lot of money, speculators, and there's other people who buy it for insurance, right? And so if you think of gold like insurance, then you don't necessarily want it to pay off, right? It's like when you buy insurance on your car, you don't want your car to get wrecked. You don't want your house to burn down. You don't want to get killed if you have life insurance. It literally is insurance. So from that perspective, I think it can be 5, 10% of your portfolio, and you just don't even think about it, right? You try to make money with the other 80 to 90, 95%. But if you're trying to speculate and you're doing high risk, high reward, then it should be a smaller percent of your portfolio. And I think everybody should have a small percent of their portfolio, maybe 4 or 5%, allocated to these high risk, high reward strategies. And I would put something like tech stocks, maybe smaller tech stocks, small cap stocks, more speculative, private equity or investing in a private Silicon Valley startup. That's more like the speculative alternative investments that I think of. And I put Bitcoin in there too. I'm actually a believer in Bitcoin. I think it definitely has its problems, and I don't think it's necessarily foolproof. But I do think that I don't think the digital currencies are going away. I think that genie's out of the bottle. Certainly things got overdone a year and a half, 2 years ago. So I don't necessarily think we're going to have that mania we had again, but I do think it's possible that a couple coins make it and that go back up to those levels.
Of course you are at a physical gold trade show today, Brent. Tell us a little bit about your perspective on physical versus ETF and how valuable that is.
So I'm a huge believer in physical gold. I think everybody should own physical gold in some form. And whenever people ask me how to do it, I always say start off with gold coins. Just whether it's $20 coins or the gold eagles or whatever they are, or maple leaves, just get some gold coins and some silver coins too. Silver in a smaller denomination. Just buy them, hide them, and put them away, and don't even think about it. And the reason is because part of the reason for owning gold is disaster insurance, let's just call it that, right? Or in some kind of a big crisis. Well, if you get into a big crisis, a lot of times the market's shut down. After 9/11, the market's shut down for 2 to 3 days. There's been several times in previous history where the market's closed for a week, 2 weeks, during times of war or whatever. Well, that's when you need your gold the most, and you can't access it if it's in your brokerage account, right? So even if you do own an ETF, I think if you own an ETF, to me that's more of a trading vehicle. You're trying to make money, it's a speculation. But if you're actually really wanting to own gold for insurance, you need to have the physical one. And I think coins are probably the best way to start, and then after you get your start, you can talk about other ways to allocate.
Sure. You talked earlier about the strength, relative strength or weakness of the dollar. And one of the things I always think about is, when I look at the strength of any one particular nation's currency, is what do they have in their own vault as a sovereign nation? Do you think currency traders or the greater market take that into consideration when they're trading a particular country's currency?
Yeah, I think the big currency traders and maybe some macro guys do, and I think they should. And to a certain extent, I think one of the reasons that maybe China's currency has held up as well as it has in the last couple years is because they've been buying a lot of gold. And there's a theory that they own a lot more gold than they say they do. And so I think that, to a certain extent, has given rise to this trend. And then there's a lot of people in the gold community who don't believe that the United States has the gold that they say they do. A lot of people think that they've sold it off into the market over the years. So I do think people look at it. I don't think they look at it as much as they probably should. But I think at higher levels, at the government level, at the monetary authority level, they definitely look at it.
Okay. Tell me about your view of how much risk the markets bear when there's the notional value of derivatives outstanding in the marketplace. Tell me a little bit about what you think about the outstanding value of those derivatives.
Well, it's a nightmare, to be honest. It's hard to even get your head around it. It's like a quadrillion or something like that if you add them all up. And this is part of the reason why I think the dollar is going to get a lot stronger. If you think about it, all of the debts all the dollar-based debts in the world are demand for dollars. So a lot of times in the gold world, you hear about how on the COMEX trades 10 times the amount of physical gold that they actually have. If everybody ever actually came to the market for delivery, it would overwhelm it and the price would go through the roof. Very true. But the same thing exists in the dollar world. Most dollars are not physical dollars. Most dollars are digital ones and zeros that get sent around the world, and it's really nothing more than an accounting entry. But when those debts start to fail, or when those derivatives start to fail, it starts this cascading effect, and all of those bonds or those derivatives that are defaulting, everybody's searching for cash. Everybody starts grabbing for cash. That's what you get, the liquidity squeeze, and you get the credit crunch. That ultimately all flows back to the monetary base, which is a set of physical dollars and reserves at the Fed. And so you get that same high amount of demand for a relatively small stock of inventory, and that pushes the price higher. And I think when we get into this stage where these bad debts or these derivatives start to crash, and some of these, I think, developed markets are taking on a lot of dollar-based debt and they can't pay it back, you start to get that cascading effect. I think that's what shoots the dollar higher. And that kind of plays into why I think gold could potentially go lower, because you need gold in a crisis, right? Now, I talk to people all the time and they say, why do you own gold? And they say, well, in a crisis, I'll be able to sell it for a lot more. But what you got to remember is people in the other countries feel the same way. So part of the reason that gold hasn't gone up a lot in the last couple of years is because Turkey and Venezuela own a lot of gold, but they've had to sell it because they've been in crisis. So when they come to market and sell, that depresses the price in dollar terms, right? Because the Turkish lira is getting crushed, and the Venezuelan, what do they have, the real? Venezuelan, anyway, but whatever their peso maybe, it's going down. So in those currency terms, gold's going through the roof. So those people are selling the gold because they're in crisis, right? And so, I think this derivative, and China has a similar thing. They have a lot of these called wealth management products, which are derivatives basically that are tied to gold. If people over there, if they go into a recession, or if they have a huge credit problem with their real estate market, if that starts to pull back and people need liquidity, now they have to liquidate those wealth management products, which ultimately means you have to liquidate the gold that are backing them, and so then gold gets sold. So it's in that type of a scenario where I could see the dollar goes up first, gold goes down. But once people figure out what's going on, I think that reverses. And then gold goes through the roof, and the dollar probably comes down. But I think these things always take longer to play out than you think they should. It feels like you solve the puzzle, and you know that's the end game. But then so you think it's going to happen pretty quickly. But nobody else has figured out the game yet, right? And if everybody else keeps playing on as if the game hasn't ended yet, you've got to wait till everybody else realizes it too. But hopefully you're in a position so when everybody else realizes that you're in good position to benefit from it.
And in that way, all markets are purely psychology, right?
A huge part of it, certainly, yes, exactly.
That's all we have time for today. I want to thank Brent from Santiago Capital. Appreciate you coming out today. I am Scott Griffin with Coin Expo Santa Clara, Rare Coin and Precious Metals Exposition. Thank you.